Homegrown Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider Morningstar.
Hello and welcome to the Global View. On this Friday, I'm Andrew Gagan. Good to have you with us here at ausbiz. So, checking what happened overnight on markets, stocks rising after the European Central Bank cut interest rates for the first time in nearly 5 years. However, market momentum faded as the bank said it doesn't expect inflation to fall back to target until 2026. Stocks on Wall Street were subdued with the S&P 500 and NASDAQ retreating from the previous session's record highs, with investors focused on the forthcoming jobs report. Tech stocks ended low, with Nvidia falling back to being the world's third most valuable company, having surged ahead of Apple the previous day. Shares of GameStop rocketed after the online stock influencer Keith Gill, otherwise known as Roaring Kitty, posted on YouTube that he returned to the platform on Friday for the first time in 3 years. He was instrumental in the 2021 rally in GameStop and other meme stocks. Lululemon rose after beating expectations for first quarter profit and revenue. Shares in lingerie maker Victoria's Secret slipped on lower first quarter profit and revenue. And US listed shares of NIO fell after the Chinese electric vehicle maker posted a quarterly net loss. Well, the European Central Bank has cut its deposit rate from 4% to 3.75%, its first move lower since 2019. The bank had all but promised the cut after seeing inflation fall to just over its 2% target. However, it says that progress has stalled recently, and the latest wage and price data have been stronger than expected, raising fears that inflation may prove sticky. ECB President Christine Lagarde saying, "We are not pre-committing to a particular rate path. Is the dialing back process underway? There's a strong likelihood." Meanwhile, German factory orders in April fell well below forecasts to be down 1.6% for the year, and Eurozone retail sales fell 0.5% in April. US weekly initial jobless claims were slightly above expectations, but markets are waiting on the key non-farm payrolls report tonight for further clues to Fed policy. Treasury yields dipped with the 10-year at 4.28% and the 2-year at 4.72%, and the US dollar largely flat against most major currencies, although the euro edged higher after the ECB's decision to cut rates. The Aussie dollar strengthening to 66.7 US cents. Well, for a closer look at the macro indicators and to get sector specific in the States, Dave Sekera, Chief US Market Strategist at Morningstar, joining us now. Dave, very good to catch up with you again, as we do every month. Interested to see then the Morningstar US Market Index, that's your proxy for the equity market, up 4.75%, offsetting that decline we saw in April. What are you seeing at the moment in terms of price and fair value?
Well, right now, the market is pretty fully valued in our mind. Now, having said that, we do see a couple of different opportunities for investors today. So when we break up the overall market valuation, we do see that value stocks are still trading at about a 7% discount to our fair value. So I do think value stocks are a good place to overweight today. But then offsetting that, I would look to underweight core stocks. Core stocks are trading at a 5% premium, and growth stocks probably a good market weight in line with the market average right now. And we still like small cap stocks. Small cap stocks trade at about an 18% discount to a composite of our fair values. So I think that's a great place to overweight stocks. Probably a slight overweight in mid cap. Those are trading at 5% discount. And then to pay for those, I would look to underweight large cap stocks. Those are just running a little bit too far ahead of our fair values. Those are at a 3% premium today.
So Dave, if investors want to outperform the market, where do they need to look?
I think you really need to start looking at more contrarian type investments today. Just looking at the market, they've really been consolidating around fair value, seeing a lot fewer dislocations at the sector level than what we saw, even 6 or 9 months ago today. So I think to some degree, you have to look for those stocks that have underperformed over the past year and a half. The ones that have negative market sentiment, those that we consider to be unloved, and of course, as always, look for those that are undervalued. So one sector which is probably the most hated on Wall Street right now is the real estate sector. See a number of different opportunities there. Personally, I'd still steer clear of the office space. I think there's downside still to come, but I think those real estate plays that have more defensive characteristics are interesting. And then to some degree, it is a stock picker's market. I think you need to start looking for more story stocks that might be emerging turnarounds, or other hard catalysts, that could cause, valuations to start moving up. Some of them that we're seeing are some of, just normalization, after, the first 2 years of the pandemic that pulled forward a lot of future demand and, a number of different areas, especially in goods, that's now normalizing. Or maybe things that are more idiosyncratic, looking for, businesses that have had a tough time. They've been going through some corporate actions, selling off different business lines, maybe getting rid of failed acquisitions and really refocusing their core competencies. So again, to me, much more of a stock picker's market as opposed to, the past year and a half where you could just play, the cloud and the AI themes.
What of those thematics, in particular AI, Dave? And obviously we've focused more recently on Nvidia, given just how incredibly it has performed. More broadly though, where would you be looking in the tech sector?
So tech, I'm actually kind of breaking that into, 3 different buckets in my own mind today. So the first bucket is going to be AI and cloud. That's the area where we still have, the highest growth today, still very good, long-term secular trends. But for the most part, those stocks are pretty fully valued, if not overvalued at this point. Now, Nvidia is a 3-star rated stock. We still think that there's probably 4 to 6 quarters of supply not being able to keep up with demand. So really with that one, I think what would be interesting is I'd keep a really close eye on, their cloud customers. Once you start seeing them start to slow their CapEx, I think that's really going to be the indication to watch for when Nvidia's growth rate, has likely peaked. But, some of the more second derivative plays, Snowflake, Cognizant Technologies, are 2 stocks that we've talked about in the past. Probably the best opportunities in tech are going to be in more of what I consider to be the traditional tech area. But again, still a stock picker's market. I think semiconductors, probably going to have to wait for the U.S. economy to rebound, which we don't think is going to be until the second half of next year. I might look more towards like the software and the service sector. ServiceNow is a 4-star rated stock, trades at a 15% discount. And I still like the cybersecurity stocks, Fortinet and Palo Alto, 2 stocks that are currently rated 4 stars today. And then lastly with tech, you've got the legacy tech. These are the names where the best days are just behind them. To some degree, they might be just long-term melting ice cubes. So the 2 there that I would point to as being overvalued in our mind are going to be IBM and HP, both 2-star rated stocks that trade at 20 and 15% premiums over our fair values.
Dave, I think last time we were talking, just looking at those opportunities of how to play that growth in AI, you were saying it's time to focus on those utilities. Does that remain, given obviously the huge amount of energy that those data centers and the like use?
It's interesting, really just over the past, month, maybe even 2, I've just seen a lot more stories out there, talking about how there's going to be so much more electric demand and, in the utility space to be able to power those AI GPUs and chips. They do take multiple times more electricity to run them. But to some degree, if you're just buying into the utility sector now to play this theme, I think you're about 8 months, too late to the game. I was actually looking at our show notes here from back in last October. I think at that point in time is when we were really pounding the table, talking about the utility sector being significantly undervalued. In fact, our team had noted it was actually trading at probably near some of their lowest valuations over the past decade as compared to our values. I think the sector's up almost 40% off of its bottoms. Now, having said that, while the utility sector itself is probably pretty fully valued on a sector basis, a couple of different stocks I'll highlight. So the first one's going to be WEC. That's the old Wisconsin Electric Company. It's a 4-star rated stock at a 15% discount, healthy 4% dividend yield. That's probably the one that we think has the best upside leverage, for that additional electric demand. We do think that in Wisconsin, they do have, a couple of good projects that are being built today in order to increase their data centers. And then just 2 other stocks that are just kind of long-time picks in the sector are 4-star rated Energy and NiSource.
A lot of movement in the commodities complex at the moment, Dave. You look at that price movement with oil, copper, gold, iron ore. What are you watching there? When, particularly, I guess, with the focus on energy with the oil price, there's some confusion about OPEC Plus's strategy going forward.
Well, and to some degree, when I look at the energy sector as long-term investors, we try not to get, overly concerned with where that short-term price of oil is going. Now, having said that, we do think that the sector is undervalued, trades at a 6% discount to our fair value. So I do think energy, and specifically a lot of the oil companies, would be good to overweight at this point. And that's even in light of our long-term oil price forecast. So our mid-cycle price forecast is $55 a barrel for West Texas. So even though we've got downside from where we are in the 70s, a lot of these stocks still model out to be relatively cheap in our view. Plus, the other reason I really like the energy stocks, and specifically the oil stocks, I think they're just a good natural hedge to your portfolio against any additional other geopolitical risk, or if we're wrong and inflation does stay higher for longer. So depending on what you're looking for among the global majors, we do like Exxon, that's a 4-star rated stock at an 18% discount. Devon Energy in the US, more of a regional play, another 4-star. And if you're looking for more of a hard catalyst play, I'd point out APA.
And Dave, just briefly, of course, as we well know, the Bank of Canada and now the European Central Bank have both cut rates.
Yep.
What's your economics team, what's its forecast? Has it altered its view as to where the Fed is going to head?
So we're still looking at the Fed cutting at the September meeting. Our base case is that they'll cut the first time there, skip a meeting, and then cut again. So we're looking for the end of 2024 for the Fed funds rate to end at that 4.75% to 5% range. But we do expect that the economy will continue to be soft. So we're looking for soft GDP for the next couple of quarters and going into 2025. So we think the Fed will continue to keep cutting the first half of 2025. So we're looking for Fed funds rate to get all the way down to 3 and 3.25% by the end of next year.
Dave, thanks so much for joining us from Morningstar.
Thank you.
Quick check of where we're likely to get going when the market opens on this Friday. Looking to be positive there. SPI futures up close to 0.25%. Stay with us because the open is just a couple of minutes away.